Hi, everyone. We're so excited to have you here today. Welcome to getting your company ready for an IPO, co-hosted by Carta and the New York Stock Exchange. My name is Jackie Ammon. I'm a business development lead at Carta. And prior to joining Carta, for about a decade, I practiced corporate law, working with companies all the way from incorporation to IPO. So I'm really excited to be here with you today. And I'm joined by Michael Harris of the New York Stock Exchange and Tom Keiser, COO of Carta. I'll let them introduce themselves.
Hi, thanks, Jackie. My name is Michael Harris. I run global capital markets here at the New York Stock Exchange. Prior to this role, I led capital markets at Citadel Securities for a number of years. Also spent some time on the buy side at Morgan Stanley Investment Management, and spent most of my years as an investment banker advising companies on going public, both with regular way IPOs, but also working in structured derivatives and also convertible financing as well.
Awesome. Thanks, Michael and Jackie. I'm Tom Keiser. I'm Chief Operating Officer of Carta. I spent the first 25 years of my career in consulting and in retail, working inside of publicly traded companies. The last 9 years, I worked with venture-backed tech startups, either right post-IPO or pre-IPO. As well as a whole lot of investing in pre-IPO companies, so doing a lot of advisory work around this topic as well.
Awesome. All right, so to get started today, we know going IPO, becoming a public company is a really complicated process. And so we want to provide some context about what it means to go public, how do companies go public, why do they go public, and the most traditional formats for going public, the ways to actually go public. And then we'll provide some data insights about the IPO market right now and hopefully where it's going in the near future. So why do companies go public? Well, there's usually company motivations, stockholder motivations, and kind of macro market economics that influence the decision. The company motivations, ultimately, an IPO is an opportunity to raise capital, right? It's a fundraising event. Private companies opt to start selling their shares publicly to raise money. It's also been historically considered, a rite of passage, a display of maturity and reputational status when you're listed as a public company. Stakeholder motivations, this is, usually the first opportunity that the full stockholder base is going to be able to sell their stock and make money off of it. So if you've heard of liquidity or a liquidation event, this is what an IPO is, right? It's the private stockholders selling their stock publicly to other investors. And a lot of times your preferred stock investors in a private company, if you're venture backed, are going to push you to IPO or push you to exit because they want to be able to liquidate their holdings, right? That's the whole point. They invest and then they make money so that they can go reinvest in other private companies. And then market motivations, right? As we're seeing kind of right now, a lot of the decision to go public depends on what you think your valuation is going to be or what appetite there is for shares in a company like yours. And so the decision to go public and why you would go public can also be impacted by market impact.
And Jackie, the other thing I'd also just add is just strategically as management, oftentimes thing that they're looking at when we kind of talk about all the different ways of going public is that trade-off between how they think about the exit value for the company, whether that's kind of a full exit in comparison to an M&A transaction, or also looking at it in terms of what's the trade-off in terms of price. So being able to achieve the highest price objective for the company in terms of the value of the equity as well. So those are kind of some of the other considerations that they think about and in terms of the other motivations as well.
That's super helpful. Yeah. And I think you also raise a good point that all of these motivations play together, right? None of them are made in isolation. Management's considering their own motivations, the pressure from their stockholders, and the macro conditions all at once. And it needs to be kind of the Goldilocks zone in order for you to, have a successful IPO. So what are the benefits of going public? One of them is, like we said, ultimately an IPO is a fundraising event. And so access to capital on the public markets is usually a lot greater than it would be in the private markets. And so if you need to raise a lot of capital quickly, an IPO is a way to do that. Also, like we talked about, stakeholder liquidity. This is going to be likely for the first time for many of your employees, some of your early stockholders. The publicity associated with your IPO and subsequent trading. So, you get to, as Michael will be able to explain, you get to ring the bell on the trading floor. Your pictures are posted everywhere. You do a big fancy press release, and I'm sure Tom can talk about this too. There's a lot of publicity that comes around, and usually good publicity about going public. And it's a useful tool for attracting talent. One thing you can think about here is the difference between the equity you can grant when you're a private company versus the equity you can grant when you're a public company. And when you're a private company, right, because you're privately held, a lot of times your employees can't sell without your permission, or, not really at all, because we want to hold on to the stock as long as we can to maximize the value. Whereas when you're attracting talent and hiring as a public company, you usually grant RSUs, and the employees can see that value as it vests, right? Because it vests and can instantly be sold on the public markets. What are the considerations of going public kind of in general? It's expensive, right? It's expensive to prepare and register. It's expensive to list, and it's expensive to comply for the rest of your company's life cycle with all the regulatory requirements of being a public company. And we'll talk a little bit more about this. There's significantly more public disclosure about what's going on at the company. So things that you didn't have to tell the public when you were a private company, you may be required to tell now in the form of an 8K filing or a 10K or 10Q, right? And so you're just going to have to be prepared to disclose a lot more about your company. For instance, your financial statements, right? A lot of times you, as a private company, you only share your financial statements with your preferred stock investors if you're venture backed. Maybe, to your employees or other stockholders in the form of 701 disclosures. But as a public company, you're releasing those every single quarter. There's less autonomy as a public company because now because of all these public disclosures and regulatory requirements and the absolute breadth of your stockholder base, you just have a little less control, right? You don't know necessarily every single person on your cap table the way you did when you were a private company. And then finally, there's always exposure to stockholder litigation as a private or public company, but the chances of it increase when you're a public company because of potential fluctuations in your stock price, right? Fluctuations in your stock price as a private company, generally no one but management would know about. Everybody knows about it, right? When you are a publicly traded company. And if the stock price goes way down, you're potentially open to stockholder litigation. I don't know if Michael or Tom, you can think of any other kind of general benefits or downsides to going public.
Yeah, no, I think that's right. I mean, the other I would also put out as far as just an additional benefit, there is a certain enhanced reputation and brand to being a publicly traded company. It helps from the standpoint of being able to negotiate ongoing bank lending agreements. It helps in terms of potential access to higher credit ratings. And so other parts of the balance sheet can also have additional benefits from having a publicly traded currency as a part of the capital structure.